Next, I asked Gemini if the conditions that tend to precede past crashes are present in today's market environment. And I liked what Gemini did here. Instead of working through a long narrative, the AI summarizes its findings in a concise table with the warning signal, where it stands today, the risk level, and a short explanation of what's driving it. This is followed by a more detailed explanation further down. We can take this in quickly. Growth is currently slowing but not collapsing. Monetary tightening appears to have paused. Valuations, though, are clearly stretched. And geopolitical risk, Fed transition uncertainty, along with AI fatigue, increase the risk of volatility shocks. One interesting point I see is this. Gemini notes that the yield curve has uninverted and turned positive, a shift that historically occurs late in the cycle and often just months before a recession begins. In other words, the move back toward a normal curve does not eliminate recession risk. Rather, it can signal that the economy is often associated with the later stages of the business cycle. Markets rarely break for one reason alone. Stress builds when several signals start pointing in the same direction. It shifts the focus away from calling a single outcome and towards a pattern where vulnerability is accumulating. That same framework shows up again when Gemini lays out the downside risks to the current rally. Each risk is tied to a mechanism, a trigger, and a plausible market impact. Inflation re-accelerating, deterioration in the labor market, and the concentration in the Mag 7 all show up here as distinct paths by which pressure could spread. For a detailed breakdown, watch the full video on my channel.